Hi, everyone. How are you? This is the Love and Money Show. And today I'm going to talk about taxes and how to avoid capital gains tax when you sell a home. Now, preferably, you want to keep your home for as long as possible because what this home is doing is it is appreciating in value. The longer you keep it, the higher that appreciation goes. However, in the event that you decide to sell a home, I'm going to tell you how to avoid paying capital gains taxes. First of all, I'm going to talk briefly about what capital gains tax is. So, say for example, you bought a house for $100,000. So now the house is worth $200,000. So the 200,000 minus the 100,000 is your capital gains. That's the profit. You have $100,000 of profit in that home. So what happens is the tax man comes and there's something called a capital gains tax. So that gain that you just made of $100,000, the tax man is coming to get taxes on that money. So ordinarily you would pay taxes on that profit of $100,000. There's something called a short-term gain tax, and then there's something called a long-term gain tax. Long-term gain tax is what you would pay if you keep the house for more than a year. More than a year is long-term gain tax. So that is a cheaper tax rate as opposed to a short-term gain tax. So if you don't keep the home very long, you're going to pay a short-term gain tax, which would be a higher rate. So the short-term gain tax is anywhere from 12 to 37%. So you made $100,000 profit. The tax man is coming to take that 12 to 37% of that 100,000. Or you kept the house for longer than a year. The tax man is coming for his long-term gain tax. That $100,000 profit, the tax man is coming to take tax of that $100,000 profit. And that long-term gain tax is anywhere from 15% to 20%. So the tax man is coming to take 20% of that $100,000 profit that you made. So that is the difference between the short-term gain tax, which is 12 to 37%, versus the long-term gain tax, which is 15 to 20%. So, how to avoid paying capital gains taxes when you sell a home. So, you don't have to pay capital gain taxes in two instances. Number one, it is your primary home. Number two, you stayed in the home for at least 2 years. If you meet this criteria, then you do not have to pay capital gains tax. And the 2 years does not have to be consecutive as long as it is a total of living in the home for 2 years. So in those instances, you don't have to pay capital gains. It's your primary residence. You lived in it for at least 2 years. So, say for example, this is not your primary home. It is a different home that you are thinking about selling and you want to avoid paying capital gains taxes. Well, there are three different criteria that you can meet to avoid paying capital gains taxes. If you don't avoid it, at least you can minimize it. So, number one, there's something called the 2 out of 5 rule. 2 out of 5 rule. So, in that instance, they're looking at how long you actually lived in the home. So, living in the home for at least 2 years would give you an exclusion of up to $250,000 if you're individual, or an exclusion of $500,000 if you are joint, if you have a family. So that is the 2 out of 5 rule. You can minimize taxes that way by living in the home for at least 2 years. Okay, say you don't want to live in the home or you have no interest in living in the home. Another way to minimize the taxes on this home that you plan to sell is selling it for specific reasons. They look at specific reasons why you are selling the home. And the reasons that they look at are if you are selling the home for work reasons, if you're selling the home for health reasons, if you're selling it for an unforeseeable event. Those are the three things that they look at in order to consider minimizing this tax. If you're selling the home for work, if you're selling the home for health conditions, or if you're selling the home for unforeseeable events. So that is the second way to minimize taxes. If you don't want to live in the home, you have these specific reasons for selling the home that they consider uh, as ways to minimize taxes. Okay, say none of that applies to you. So the third way to minimize taxes would be making home improvements and keeping all of your receipts. So they take those home improvement receipts into consideration. So the higher the cost basis, the lower your capital gains tax would be. So what you don't want to do is be making improvements on homes and not keeping the records of it. Say, for example, you replaced the roof or you painted the deck, uh, things that cost a lot of money, or even things that don't require a lot of money. Everything adds up. So, what you want to do is make sure that you are keeping all of your receipts for home improvements because this matters when it comes to minimizing your capital gains taxes. So those are the three considerations to take into consideration when it comes to minimizing your taxes so that when you get to a point that you're willing to sell the home, when you have this big profit because you let the house appreciate, the tax man is not going to come and take all of that profit. So keep that in mind. Living in the home, if you don't want to live in the home, having specific reasons for selling the home that they consider. Again, that is for work reasons, for health reasons, or for unforeseeable events. The third thing is keeping all of your receipts for home improvements. So when you have that profit, that $100,000 profit, you can actually take that profit and keep it for yourself instead of the tax man coming, taking 20% of it. So, this is the Love and Money Show. If you like this show, please hit the like button. It helps the channel. Hit the subscribe button if you're not a subscriber, and also leave a comment and let me know your thoughts. Thank you for watching. Have a good rest of your night.